All right, let's get right into it. We're breaking down the post-market wrap for Wednesday, January 14th, 2026. And this was just a bizarre day.
Bizarre is the word. You had headlines screaming sell-off.
Right, cognitive dissonance everywhere.
Hmm.
But then you look under the hood at the internals, and they're whispering something completely different.
Definitely much more bullish.
Exactly.
Yeah.
So our mission here is to connect those dots for you. We need to figure out why the indexes fell off a cliff while the actual market action seemed incredibly strong.
Yeah.
Let's just start with the final scoreboard because it was a clear reversal day. The S&P 500, that's your bellwether, it finished the session down 0.9%.
Mm-hmm.
The Nasdaq, all the tech names, slid even further, lost 1.5%.
Which is a big number.
It's a big number. And the Dow was, a bit softer, only down about 0.4%.
So if you just glanced at your phone at the close, you'd think, okay, the bears are back in control. But this really was a classic reversal day. And more than that, it was a very low conviction session. I mean, the indexes tell one story, but the plumbing of the market, the breadth, the volume, the rotation, it's telling us a completely different story about where the real money is going.
Okay, so let's unpack that. Surgical rebalancing, you called it?
Yeah.
Why the sharp drop then? Especially in all the high beta tech stocks. The sources are pointing to something they call earnings indigestion.
It was, and it was all about the banks. The market came into earnings season really hoping, that the financials would kick things off with a bang.
And they beat, right. I saw Wells Fargo, Bank of America, they both beat.
They did. They technically beat on the top and bottom lines, but the market just, it looked right past it. The focus immediately shifted from last quarter's good news to the next 4 quarters of potential threats.
So the good news just got completely ignored. Why? What was the threat?
Well, it was a couple of things. First, rising expenses. That squeezes margins. But the real killer, the thing that hit the sector like a freight train, was policy. It was that threat of the new 10% credit card interest rate cap.
The regulatory risk.
That was it. BofA and Wells just, boom, dropped 4 to 5%. And when a huge cyclical sector like financials gets anchored down by that kind of uncertainty, the whole S&P just struggles to find its feet.
So it's not just earnings, it's a policy problem. And we had some macro stuff feeding the fire too, didn't we? A hot PPI print.
Yep, a hotter than expected producer price index plus a Supreme Court delay on a tariff ruling. It's just uncertainty. And if there's one thing big institutions hate, it's regulatory and policy uncertainty.
So that was the excuse.
It was the perfect storm for profit-taking. I mean, think about it. Traders had these huge gains from the start of the year, mostly in a few big tech names. They see this policy chop hitting the banks, and they just say, you know what? Time to take some risk off the table.
They sell their winners.
They sell their biggest winners first.
Okay, so if traders were lightening up, where did that capital go? Let's trace the money flow, because that rotation says a lot about what people are actually worried about.
It really does. And the rotation was severe, very directional. Financials were the anchor, obviously. But the leader, unequivocally, it was materials and precious metals.
So a flight to safety.
The pure flight to safety. I mean, this wasn't a risk-on move at all. You had silver surging over 6%. Gold hit new all-time highs.
Wow.
That tells you traders are hedging. They're hedging against what they see as rising political risk, maybe some jitters about the Fed's independence. When things get unpredictable, capital flows to hard assets.
Right. And then you get to the really interesting part, which is where the high beta market started signaling not just profit-taking, but actual institutional distribution. Let's talk about the NVIDIA trap.
Oh, the NVIDIA move was textbook. An absolute textbook example of distribution. The stock opens up, 1.4% on some good analyst chatter?
Yeah, it looked like another green day.
Exactly. Bulls were still in control. But then it closed down 0.8% right at the absolute lows of the day. That kind of high-to-low reversal selling into strength, that's the big money quietly getting out.
The sources are calling it exhaustion setting in at the top of the AI cycle. Is that what this is? Are we seeing peak AI growth estimates?
It's probably a bit of both. You're seeing the selling in those high flyers, and the market is essentially saying, okay, we've priced in perfection for the next year and a half, time to cash some chips.
So not the end of AI, just the end of the easy money phase.
Precisely. And now compare that to what you saw in a defensive name like United Health.
UNH.
Yeah, UNH, and a lot of the healthcare names sold off in the morning on those same general policy fears. But then you just saw this steady accumulation all day long. They finished well into the green.
So that's the smart money rotating.
That is smart money in action. They're dumping the concentrated high beta tech and hiding those profits in companies with heavy cash flow that'll perform no matter what interest rates are doing.
Which brings us to the conviction check. Because with these big moves, you always have to ask, was there real money behind it? What did the volume look like?
And that was the tell. The lack of conviction was maybe the single biggest signal of the day. Aggregate volume. It finished a full 8% below the 30-day moving average.
8% below on a nearly 1% down day for the S&P.
Exactly. The interpretation there is pretty unambiguous. It was a low conviction session.
So today's price action is, like sources say, written in pencil.
Written in pencil, not permanent ink. This was driven by algos rebalancing, options hedging, maybe some retail traders trying to buy a dip. The big long-term funds, they were mostly on the sidelines.
And you could see that institutional caution play out in the last half hour, right, in the market on close.
Absolutely. The smaller indexes tried to stage a little rally into the close.
A little head fake.
Right. And we saw a very distinct fade the rally profile. The MOC imbalance was heavily skewed to the sell side. That means the big funds were using that little pop of strength to lighten their exposure, not to buy in.
So if you put the volume and the MOC together, institutions are basically saying this range, around 6,960, is fair value for now.
That's it. They're not panicking, but they are not aggressively chasing this dip either. They're harvesting gains and being patient.
Which, I think, leads us to the most important signal of the day, the aha moment, the thing that totally contradicts the headlines.
The great divergence.
And for anyone listening, let's just frame why this is so important. Usually the warning sign is the opposite, right? The index hits a new high, but breadth is weak. That means the two mega caps are holding everything up.
Exactly. That's a sick market. Today was the complete opposite. You had a price dip, but underneath you had record participation.
So this is healthy.
This is a healthy correction. The market is literally fixing its own concentration problem in real time. This is capital expanding beyond just a handful of names.
So the narrative is shifting from an AI-only rally to more of a global growth rally.
You can see it perfectly in the Russell 2000, the small caps. It just matched its longest outperformance streak against the S&P since 1990. That's 9 straight days.
Wow.
The money is flowing into the cyclicals, the industrials. It's strengthening the foundation of this entire move.
So if the internals are so strong, what is holding the index back? What's creating this jagged sideways price action?
And that brings us right back to policy and the volatility structure. If you look at the VIX, it's telling you a story. There's a volatility shift happening. It's slow but rising.
Low but rising. It's creeping up toward that 1820 range from, sub 15 at the start of the year. But implied vol isn't spiking everywhere.
It's selective.
Very selective. The cost to hedge is soaring in the banking sector because of that rate cap noise. Meanwhile, tech vol is pretty flat. So it's policy risk in specific sectors that's capping the whole index.
And that defines the market we're in. We should expect this choppy sideways grind because of this political risk premium.
That's it. Policy noise is the ceiling. But, and this is critical, you have to remember the floor. December core CPI came in at a 5-year low, 2.6%. The fundamental economic floor is solid.
So the fear isn't the economy, it's the politics.
Precisely.
Okay, that sets us up perfectly for tomorrow. The market closed at 6,963.74. We are technically trapped between two massive options levels. What are the lines in the sand?
We are right in the middle of the gamma range. The simplest way to think about it is there's a shock absorber above us and a trampoline below us.
Okay, I like that. So it's the ceiling, the shock absorber. The ceiling is 7,000. That's the gamma wall. If we manage to reclaim that level, it forces the big dealers who are short options hedges to start buying back their positions fast.
The delta squeeze.
You get a delta squeeze. A powerful short-term burst of demand that could push us right up to 7,024.
And the trampoline. The trap door.
That's losing 6,900. That is the zero gamma flip. Above that level, dealer hedging creates stability. But if we break below it, the market flips into what's called a negative gamma regime.
And that's when things get wild.
That's the trampoline. Dealers have to start chasing price moves. Drops get faster, rallies get quicker, volatility just explodes.
So the strategy is to expect choppy, mean reversion. Don't chase the open. Wait for that maybe 10:30 a.m. Eastern reversal window.
That's the smart play, but we do have a catalyst. The big hook for tomorrow morning is TSMC earnings.
The AI stress test.
The ultimate AI stress test. After watching NVIDIA get distributed today, this report is huge. It will either validate the semiconductor dip or it'll signal the first real crack in the story.
And that will set the tone for all of tech.
The whole sector. And you have to connect this to the rotation. Watch Intel, INTC. It jumped over 7% today on a big upgrade for its cloud server business.
A laggard waking up.
A classic laggard catching a bid as money rotates. That sets up a beautiful gap and go or a dip buy play if it can hold its levels, especially if the TSMC report isn't a disaster.
Okay, and one last proxy play. Coinbase. CoinM.
Right. For the crypto speculation angle, Bitcoin is testing that big $100,000 psychological level.
It's right there.
CoinM cleared its 50-day moving average today, so it's the highest beta way to play that squeeze. If Bitcoin can hold 94K, I'd watch for CoinM to continue, maybe targeting the 280 strike. That's where all the options gamma is concentrated.
So let's bring it all home. The core takeaway here is that today was not a broad fundamentals-based sell-off. This was a surgical rebalancing.
Exactly. Driven specifically by political risk hitting one vulnerable sector, the banks. The data is telling us that the big tech tax, or at least, some serious profit-taking in names like NVIDIA, is real. But the rest of the market is on fire. Your focus shouldn't be on the S&P headline. That's just noise.
So ignore the cap-weighted indexes.
For now, yeah. You need to stay long. The broader market, the equal-weighted S&P, the RSP, the small caps, IWM, that is where the real bull market is accelerating. It's fixing its own flaws and getting ready for the next leg higher.
That breath signal really is everything. All right, keep your head on a swivel. We will be tracking those gamma levels tomorrow.